Welcome everyone to this live broadcast of Manufacturing Talk Radio. I'm Tim Grady. I'm here with Lou Weiss. He's president of All Metals and Forge Group and the founder of Manufacturing Talk Radio. If you're looking for open die forgings for industrial uses like those gears behind me, big gears, check them out at steelforge.com. Joining us is Tim Fiore. Tim is the committee chair for the Institute for Supply Management's Report on Business. The manufacturing report is what we're going to drill down on today. Always great information. Tim, it looks like a pretty solid report. Thanks for joining us.
Yeah, good to be here, guys. Yep, absolutely. I think the market didn't react very well to it. We definitely underperformed compared to what the economists thought, but that's okay. I mean, I think it's explainable. People are looking for not so good news. They're not going to find it here. So, although our PMI index came down to 55.4, a number of different reasons for that. So, I put all these things into the demand category. I include the new order number along with new export orders, customer inventory, and backlog. New export orders are weak, no doubt, no big surprise, just like last month. Europe's not out there investing a ton of money. They're not exactly sure what to do here besides probably arms, and we'll see how that works out. China's been locked down now for a month, so there's nobody out there placing orders either. So new export orders, very explainable. Customer inventories came off 3 to 37, still way too low. I'm not nervous about that. We're still 20 some odd months below 40. I'm not nervous about that at all. So then you get to the backlog at 56. Well, if you didn't have a lot of new orders being placed, then you'd expect backlog to kind of relax a little bit. The backlog is still at historical averages and good growth periods. So running at 64, 65 was very unusual. We actually set records when we were at that level. So now to 56, okay, that's fine. So then the story becomes a new order level. Look, there's a number of reasons for that. First off, you've got extremely long lead times. CapEx and raw material are at record long lead times. You got the highest prices in 30 years. So if you were a buyer and you were outlaying out orders, you've already placed orders well beyond your normal lead times at prices well above what you normally want to pay. And you have this whole uncertainty that's being kind of groomed in the market about, oh, okay, everything's slowing down. You would slow down. I would wait because you're expecting those lead times to kind of come back down and prices to come back down with it. And then you'll start placing orders again. So that could be one good reason for that. Remember, everything that we're building today was probably placed on order 6 to 9 months ago. And most companies don't have any open order positions for 2022. It's 2023. So I would wait. The second thing is that we have seasonal adjustment factors. You guys know that. We've had them. I believe in them. But I can also argue that there hasn't been any season outside of the holiday season since the pandemic hit. Everything else is just trying to catch up. So, March, April, May are strong manufacturing months, as Lou knows. Strong new order months, strong production months. The fact is that we actually took almost 4 points off of each of those numbers in the month of April. So the new order number would have been 57.5. The production number would have been about the same, and it wouldn't have caused anybody any concern except we took 4 points off. So I think you could almost say, look, until we get back to normality here or get well away from the unusual, abnormal COVID issues, and the seasonal factors are interesting, but I don't know that they really tell the whole story. So that's kind of it. I mean, we had 3 to 1 positive demand sentiment to not so positive, very high numbers still, no indications at all from anybody about weakening demand. All the comments are focused around getting stuff delivered to me, as well as how much I'm paying for it. So that says a lot, because if buyer supply managers were concerned about future demand, they'd be making the comments, and they wouldn't be trying to hire as many people. More of my comments would be about concern for the future, and they're not. They're about, I can't get the parts I need, lead times continue to push out, and I can't believe these prices I'm paying. So, I think demand's very solid, and that's one, as I've said many times, if you got demand, everything else is just a task.
You mentioned in the beginning of your comments about the market not taking it well. Were you referring to the stock market as of this morning?
I think everybody who watches the economy, not just the stock market. I think the economists had us pegged at 57.3 or something, 57.8. So we way underperformed.
But economists don't guess very well anyway, for the most part.
Yeah, you can't get them to commit anyway.
Yeah,
And
they're
then
all
if you get enough of them
ex-weathermen.
together, if you get enough of them together, it's probably like this.
We're like this.
Yeah, if you put all of the economists head to feet, they'd never reach a conclusion.
Well, that's exactly right.
That's what we've got now. The report itself, I was looking at the subcategories that roll up to the 55.4. But I didn't see anything particularly dramatic. I mean, they all went down a little bit, but they didn't go down a lot. It seemed to be a pretty strong position that we're in.
Yeah. Okay. So let's look at the input side. Input
Okay.
side, supplier deliveries, it's raw material inventory, it's imports, and it's prices. So we saw a little bit of easing on the price side, down 2.5 points, still 85 on prices. But I'll tell you, when you dig into the report, 4% of the respondents said that they were paying lower prices compared to 1% in March. All right, so that's a good sign. That's a good sign. Imports are very low, very sluggish. No boats are sailing this way. That's something that's of real concern in the future. That's probably going to drive the input side now through probably the end of the year, which we'll talk more about later. Supplier deliveries up another 1.8 points. Okay, we're at high level 67.2. I expect that number is probably not going to get much below 60 through the rest of the year. It's going to continue to be labor constrained because the whole story here is really around labor, as well as now transportation network constrained once people start shipping out of Shanghai again. So the story on the input side is more around the inventory number coming down almost to 52. It came off almost 4 points, and it shouldn't have. So I think it's really a timing issue, a March, April timing issue. And I expect that, and I know a lot of companies shipped a lot of product out of semi-finished goods and finished goods in the month of March, and to some extent April here is continuing on. So I'm thinking in May, we'll see that that manufacturing inventory number probably get back up to the 53, 54, 55 level, which that's where I would expect it to be as long as you continue to have supply chain problems, which we are going to continue to have. So that then gets us to the output consumption side, where I think the whole story is this month. And like I said, we took 4 points off the production number. That would have, if we hadn't, it would have got us to 58. Still weaker than I would like to have seen, but more in line with the historicals. I've been waiting for that production number to get to 62, 63. We just can't seem to get there. And the combination of labor and supplier delivery issues. So the real story this month is we almost went into contraction on employment. And so let me give you some numbers on employment. We had a 20-to-1 hire to force manage number, 20 companies hiring versus 1 managing headcount. That's a huge number, up from 15-to-1 in March. So still a very strong, I need to hire. That 50.9 number on the employment index does not reflect the fact that people are letting people go and they need to cut their headcount. That reflects the fact that they cannot get to the level that they need to get to. And that level should probably be somewhere around 58 to 60. So the difficulty in hiring, 34% of the comments in April, up from 28% in March. So, and very consistent with what we saw in February when we had the Omicron issue. So people are still trying to hire and they're having more difficulty this month than last month. The reason is that the backfill rate has increased again. We're running at a 32% comment backfill versus 24% in March. So the whole pace and acceleration of people quitting for higher paying jobs, I would say, is increasing. And it's causing our panelist companies difficulty in staffing the factory floor. They're not gaining. I think at best they're treading water. And along with that, they're losing productivity because they got to train people. And then, the last number here is, I do ask them, is it easier to hire in this month versus the prior month? Only 1% said it was easier in April versus March. In March, 12% said it was easier than February. So, it's a hiring story again. Then if you look at the general comments, which are headline comments, 13% of the general comments were labor related, both at the panelist companies as well as their suppliers, up from 8% in March. So it's a labor issue. If we had the labor that we need, even though we're running at a 3.5% unemployment, whatever, we just don't have the people We just don't have the people. And I think, I've been talking throughout the morning. I don't know where we're going to see the relief here outside of, high school graduations and college grads. I don't know where the relief is going to come from. So we're going to continue to have this governor built into the supply chain side as well as the labor market. That's going to stretch out this cycle longer than the typical 34 months. We're now 23 months into what is normally a 34-month expansion cycle. And I've been saying for a while now, we're probably 42 to 45 months with this cycle. And I feel more confident that's where we're going to be. So no indications of demand relaxing. That's all an input issue. The input is primarily labor at not only the supplier facilities, but at the panelist companies. And it continues to hold us back.
You say that it's mainly a labor issue, but what about pricing on raw materials? Doesn't that have some factor in terms of new orders and so on?
Well, I think when it becomes an issue, you're going to see lead times collapse.
Meanwhile, lead times are
Record.
still going out.
Yeah, they're very strong. We're seeing some relief on the pricing side. We're down 2.5 points. It's still very high at 85. But I think a lot of that has to do with the energy markets and the fact that this time around, when energy went above $100, it went right into the transportation costs and it got passed right on to the panelist companies, and they reported it. Now if you look at some of the commodities, steel is starting to come back a little bit. Aluminum is relaxing a little bit. Copper to some extent. So it seems that we're back on that late Q4 activity where prices were starting to get back to something that is more palatable. But that number it did a reverse with Russia invading Ukraine, and it's primarily around international oil markets, which then bled into everything else.
You know what I found interesting, and this is just a side story, that the US government relieved Ukraine of steel tariffs during this war they're having. Meanwhile, none of their steel mills are operating and they're using them as shelters.
Yeah, I saw that. I saw that big, shelters. Actually, it looked to me like what they were saying was, we know you don't want to destroy this massive capital investment, so we're going to park here. But eventually they destroyed it anyway, I think, right?
They did, they destroyed it. Yeah. But we gave them relief from the steel tariffs to the United States.
Perfect. Wonder if they had the inventory.
So what's the logistics issue? How is that playing a role? They don't have ships, they don't have containers, they don't have drivers. Doesn't that affect production, shipping, revenues, and so on?
Well, I mean, there's definitely people who are feeling that with the spot rates coming down and people moving more towards contract rates, that the road freight issue is easing. And that's probably true. But what's missing is the fact that there's hundreds and hundreds and hundreds of ships off the shore of Shanghai, Ningbo, and Shenzhen waiting to get into port. And even when they get into port, there's thousands and thousands of containers that haven't been able to even get to the port because the truck drivers weren't allowed to cross city limits. And all those ships are going to get loaded up and they're all going to set sail for Europe and the US, and it's going to be like a tidal wave. And they're going to get here. A lot of the respondents felt it's going to show up in late May, early June. So we're going to start to see the impact of that. In the meantime, people are talking about flying over it because they need goods. They can't wait 6 weeks on a boat or 8 weeks. They need the goods now. So here we go again. This feels exactly like what Q3, Q4 of last year felt like, with the ports being overwhelmed. So they're going to get overwhelmed, no doubt about it, just in time for the longshoreman negotiations on July 7th, which who knows where that will go. And then when that gets resolved, here comes the holiday rush.
So this is all good news, huh?
This is good news.
That's
good news.
I like this news.
Tim,
I'd much rather deal with confusion than deal with a softening economy.
Well,
That's
got a
true.
good point there.
Well, they are talking. I'm sorry.
All of these shortages that we, the consumer, are experiencing, I just have to question of the manufacturing sector, and you might not know this, but in the manufacturing sector, what is their reliance on imports in terms of a percentage of their raw materials coming in? Is it higher than, 10%? Is it 50%?
Well, I mean, I think the number is 600 billion coming out of China alone into the US. So it's a really serious amount of their GDP. I ran the numbers during the tariff days. I think it was like 5% of their output. If you look at the manufacturing sector, we're what, 2.5 trillion, 2 trillion, 2.5 trillion maybe.
Yeah.
And with 600 billion of inbound material. So it's not insignificant.
Yeah, it is not insignificant.
Now, the issue is real versus nominal, and I can't really do that calc. If you look at the real manufacturing economy, I think the real GDP of the US is 22 or 23 trillion. I think if you look at the nominal, where you have, pyramiding, it's like 35 or 36. So I might be giving you real and nominal, mixing apples and oranges a bit, but it's not insignificant. And the problem is at all tiers of the supply chain. So, you might look at all of your suppliers. No, I don't have any suppliers in China. Then you go to the next tier and they look, no, I don't have any suppliers in China. Then they go down to the next tier, which is usually, 15, 50, 500. And you find that they've got a whole ton of suppliers in China.
Right.
That's the challenge.
Well, here's a challenge that we rarely talk about, and it just struck me so over this past week that I just wanted to throw it out at you. The West Coast has been having the most horrendous drought, maybe ever. I saw on the news Lake Powell, where you were actually able to see the bottom of the lake. It's pathetic. That's going to affect people in many different ways. Production of goods, power, energy, and so on. What's the end game on this? Is all the manufacturing going to move to the East Coast eventually?
Yeah, I think I saw the same thing you did. It's alarming, where they're actually taking agricultural land out of use in Arizona because there's tiers of water rationing, and that's the first one is food. So, I don't know where that's going. I've been watching. I've flown over Lake Powell so many times. Been watching that water level drop for many years, and where it's going, I don't know. But it's a good point. I mean, at some point, it's like energy. I mean, manufacturing it's all going to Texas.
Yes, it is. Well, an interesting food tidbit, if you will, is that, the number of almond orchards in California is significant. And the big new fave these days is almond milk. So it takes 1.1 gallons of water, and most of these are grown in California, to grow one almond.
Wow.
And
How
it tastes like hell. Almond milk.
1.1 gallons of water to make one almond. Now, how much juice are you going to get out of that almond when you squeeze it? So, part of their water problem is that almond, great product, great food product, great nut product. I'm not sure that almond milk is the right route to go in the midst of a drought.
Well, those things are all going to have to be rationalized. I do remember Barcelona has a very large almond growing area too. Import the product.
Yeah, exactly. They have more water. So it's, there's a lot of headwinds in this mix, but it's still very strong, Tim. We know normally we talk about headwinds and we're looking at going off the cliff. Now we're talking about headwinds, but it's still very strong.
However, they are talking the I word and the R word, inflation and recession.
And I just heard stagflation here recently too. So is
Which
any of
word?
this showing up?
Stagflation.
Any of this showing up in the report, Tim, from your respondents or from what you can glean?
Well, hey, demand's solid. And like I said, lead times aren't coming down, so nobody's canceling anything. It's still supply constrained growth, and growth is still very strong, and nobody's putting hiring freezes on, none. So, and this is, I've been watching this very closely, and the reason I watch it is to see when things start to turn, and they're not turning. So I saw something this morning. America still have $2 trillion saved up from being locked down themselves for a year and a half. That's still money that needs to hit the market. I mean, it's not going to stay in the bank forever. So, and we always thought as the service economy opened up, there'd be some amount of overlap. Well, you still can't get a new car.
Right.
You can't get a new car, and they're saying that second half, the semiconductor issue should relax a little bit. Well, maybe as long as Omicron doesn't end up in Malaysia. So
Yeah.
we'll see. Yeah, we'll see. I mean, we're hiring, we're growing, profitability is good, earnings season is out. There's some areas that are missing. Many of those areas are ones that grew exponentially during the lockdowns because they had products that people wanted during the lockdown. The issue around Amazon, nobody went out to stores. Now people are going out to stores again. It didn't go away. Maybe some of those patterns have changed a bit and people are ordering more online, but obviously Amazon took a hit for that. There's a number of Netflix, same issue with there's a number of those. So, but then in the meantime, the basic fundamental stuff continues to expand.
Well, the Chinese have an old saying, may you live in interesting times. And we do.
Yes, we do.
And so are the Chinese.
That's the whole global supply chain issue is still on us. We've talked a bit about this, and there's a strong belief that there's been a lot more risk reduction activity underway for the last couple of years. I honestly believe that, but we're still subject to COVID issues around the world, and now we've got global economic issues, driven by local feelings. Russia invading Ukraine. I mean, we'll see where all that goes. That's just not. There's obviously an issue here around food that's already impacting people, and fertilizer, and they're not going to be able to plant as much. What does that mean at the end of the year and stuff? And Brazil's going to have to make up the difference. The U.S. will have to make up the difference. You see what's happening now with our energy markets with natural gas. We're shipping more and more of it to Europe now, and our plan is to continue to do that. There's a lot of fundamental things happening here that are going to take some time. In the short term, I'm watching palladium and I'm watching neon, and we're about 3 months into this thing. There's probably another 2 to 3 months before we start to run short of global stocks on palladium and maybe even more importantly, neon. And hopefully there'll be a replacement for neon in the manufacturing sector for microcircuitry by the time we run out.
I find one thing that's very interesting, being in the sales of metal and metal products. At one time, when you quote a price, you would get, oh, that price is too high, and they'll go buy it from somebody else. And we have a fairly good repetitive business, and nobody's complaining about prices, even though the prices have gone up. They don't want to say anything bad about the prices. And I find that very interesting. They're paying it. And they're passing it on to their customers, and they're paying it.
Right. And that's why our price index is so high, because that represents the entire value chain. So everybody's passing it along. And I've always found in my career that when raw material prices go up, everybody makes more money. So they pass on $1, they take $1 input and they pass on $1.05. That's what happens. And when prices collapse, that's when nobody makes any money.
Right, right.
That's very true. So Tim, how does your number equate to GDP as we wrap up this segment?
Well, I don't really watch that because it's definitely over time. All I did do though is I did watch what happened in Q1, as I mentioned. I think I mentioned earlier, and durable and non-durable goods expanded in Q1, just like our PMI said that it did. The big issues was really a drawdown in inventory, which I think was not to be unexpected, but it also means it will be built back up again. And the net export orders, which is a function of the fact that we received a lot of imports, which we're probably going to see a little bit of a dearth of that in Q2 here, which will offset that whole impact on GDP. I think you got to start looking at, I mean, even even what the Department of Commerce does. Q3 GDP, Q4 GDP at 6.7, Q1 GDP at minus 1 point something. No, I'm sorry. You're trying to chunk things into quarters, and we're not in that kind of environment anymore because of excessive lead times. It's not what we're at. You have to look at the whole thing over a longer period because things come up. I mean, this whole lockdown in China, 1 month, and it's going to impact everything for 3 months.
No doubt. We have more interesting times that we'll live through. But Tim, thanks for joining us and sharing the manufacturing report on business from the Institute for Supply Management.
Okay, thanks for having me, guys. Good to see you. Speak with you in June.
I'm sorry, say again?
Speak with you in June. You guys gonna be at the conference?
In a manner of speaking, we're doing a beautiful hybrid.
We're going to do a hybrid.
Okay, I can support you.
Thank you.
You bet. We got the semi-annual coming out too, I think, soon.
Yes, it is. So
Yeah.
we'll be talking to you probably in mid-May or so.
All right, sounds good.
Great.
All right.
Thanks,
Be
everybody.
well. Take
A
care.
couple of things to be aware of, folks, while you're surfing around the web. Stop at ismworld.org and find out about their conference in Orlando and their semi-annual update. 2 very important events. And while you're out there, go to jacketmediaco.com. Come visit us for this show and all of the others on Manufacturing Talk Radio. Thanks for being with us.